The Federal Reserve just lowered interest rates by 0.5%, which is going to shake up the market a lot. And in this video, I'm going to teach you and show you what are the best investments to make, which stocks to buy when interest rates are going lower. So let's jump into this video. All right, guys, so I'm going to be going through my research right now, and I'm going to be showing you the different stocks I'm going to be investing in. As always, I respect your time, so before I go into the research of why I think these stocks are going to go up, if you want me to just get to the point, here are the stocks. It's going to be JP Morgan, Bank of America, Walmart, Target, Johnson & Johnson, Procter & Gamble. I'm going to be talking about my double dividend strategy on Kraft Heinz, AVGO, and I'm also going to be talking about several tech investments that I already have, Amazon, Tesla, NVIDIA. So those are the stocks. Buy them. But if you want to listen to why in my analysis, here we go. So hopefully you appreciate me getting to the point here. So first of all, the Federal Reserve rate, they made this 50 basis point cut, but I think this is a short-term fix, guys. This is a short-term fix that the Fed is trying to solve in the economy, but we have deeper issues. We have a lot deeper issues because cutting interest rates won't solve the deeper economic problem, okay? Like inflation, a recession. I have some data here, okay? So in fact, cutting interest rates is just putting like a band-aid on the problem, guys. You have to realize this, that cutting interest rates doesn't actually solve the underlying issue, just like doctors who give pills don't actually solve people who are obese. They're just giving you a pill to, hey, this pill will fix you. No, that's not really how it works, all right? That's also not how it works with finances, all right? It's a little bit more complicated than that. So, look, why do I think that inflation pressures will persist? It's very clear, guys. It is extremely clear because, look, rate cuts may boost demand, right? But if supply-side issues like rising input costs or labor shortages aren't resolved, inflation can remain high or even worsen. All right. So, in my opinion, right? If you look at the basket of CPI goods, right? The basket that counts for inflation, they're lying to us. For example, how are they lying to us with data? CPI includes, let's say, beef prices, but it also includes substitute goods. What is a substitute good? That means that this labor department, right, of economics and inflation, all the data provider, they will take beef prices and substitute it for chicken. Why? Because it's a substitute. People eat chicken instead of beef because it's a protein. However, that's lying because, guys, do you want to eat beef dinner or do you want to eat chicken dinner? Beef is more expensive. So when beef prices go up by 50%, they can swap that out of there, and let's say chicken prices went up by 5%. Real inflation is very high. It can go up 50%, but they're going to say, nah, it went up a lot less, okay? It went up a lot less because they're using chicken, not beef, all right? That's a big issue, right? Also, one thing that I wanted to say is this rate cut isn't going to solve the issue of the debt burden, all right? We have a huge debt burden in U.S. We keep fighting wars and other issues, political stuff. But look, we have a debt problem. It's pretty obvious. We have a debt problem, and essentially lower interest rates encourage more borrowing because the debt is cheaper. So that's a good and bad thing. If you look at stocks, especially tech companies, guys, I'm actually very bullish on Amazon, Google, the Mag 7, Amazon, Google, Apple, Microsoft. I'm bullish on these stocks right now. You should be buying these stocks when interest rates fall, okay? You should be buying tech companies because tech companies benefit with lower interest rates. When interest rates are lower, these tech companies have more money that they're borrowing, which actually helps them hire talent. And technology companies like Palantir, like Tesla, any of the Wall Street darlings that you guys are invested in, I'm invested in, right? Actually, let me pull up my portfolio real quick. I'm having a fantastic day in the market. I'm up $50,000, as you can see right here on the screen. I'm at $3.28 million. We are on the road to $4 million, guys. By the way, I've decided that I'm not doing any more cookie cutter Discord stuff. I'm going to be personal and doing one-on-one coaching. So send me an email if you're interested, or first link in the description. I just want to focus on smaller amount of people, luxury, and just really focusing one-on-one. I want to be more personal. I'm old school, guys. I'm 30 years old, right? About to be 30. And social media has opened up a lot of opportunities for people, has opened up a lot of opportunities for quantity of products and services which YouTubers sell, but I'm old school. I'm going old school. I'm just doing one-on-one. So anyways, look, my portfolio is on the road to $4 million, and several of the positions that I think are going to benefit with the interest rate cut is just going to be straight up Apple, on Amazon. I have Google here, which Google has had a very big pullback. Now I have some more data I want to share with you in just a moment, but I just want to talk about the portfolio a little bit and what I'm investing in. Palantir, it's contributed to a lot of my portfolio gains. Palantir got included into the S&P 500, so obviously I'm getting rid of the cold. S&P 500 is a very big deal, guys. S&P 500, because listen, to get into the S&P 500, there's a secret. You got to be profitable, which is a good thing. If you're investing in a company, you want a profitable company. That's very, very good, right? So before, Palantir was making money, but it wasn't hitting their bottom line. Now it's no BS. GAAP EPS is positive, all right? That's really strong, and that's a really, really good sign here as an investor in Palantir, in any of the tech companies. Guys, you need diversification, all right? Now, I would argue that Charlie Munger even actually said that you want to have several basket of goods and focus on that basket very closely. I actually agree with that a lot. That's why I say we need 10 stocks as investors. My portfolio right now, I think we're killing it. Makes sense why I'm up so much money today on Apple and PayPal. They're crushing it. Snap is crushing it. Snap's almost at $10. Google's everything's doing well. But I got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 stocks. I recently got into Adobe. So 10 to 15 stocks is all you need. All right. And look, going back to interest rate cuts, the asset bubble risk. I want to talk about the asset bubble risk because look, there is a risk to a financial crash. Guys, it hasn't happened for a long time. It's been since COVID, really. Since COVID, right? But before that, it's been some time. Obviously, 2008 really stands out. I was pretty young, but I've studied in college finance, economics, business analytics. I have a degree in basically three degrees, all right? 1 degree, 3 specializations I went to college for 5.5 years. So I spent a lot of time. I didn't finish a master's degree because I didn't want to. I wanted to start actually working in the real world. And then once I started working in the real world, I realized trading is way better because I don't want to work at a corporate job. And God bless me that I don't have to work at a corporate job. I'm really not fit for it, and I'm not a morning person, and I don't want to wake up and sit at a desk. I've been fortunate to be able to focus more on health and trading, and I love it. I love it. It's been the biggest blessing of my life to work online, travel. I live in Eastern Europe right now. I have roots here. So, look, there's a lot more stuff I want to talk about. I'm sorry if I'm giving you a little bit more stories here. Let me get to the point. Asset bubble risk. Cheap borrowing can inflate asset prices. So, when interest rates go lower, stocks typically go higher. And that's not necessarily a good thing because there's a lot of enthusiasm. There's a lot of stupid money in the market. And then the market gets inflated, and then we have a big crash. And for lack of a better term, it's just better to have very stable returns, in my opinion. That's why when I sell options, I go for stable, passive, consistent income, and I want it to be reliable. I need it to be reliable, not just for me, but for my students. I need it to be peaceful. I need the peace in the stock market. In the returns. The stock market is not going to be peaceful. I need my returns to be peaceful. The stock market's never peaceful. But I need steady returns because that's how you live a lifestyle that you achieve retirement. Otherwise, you can't retire if 1 month you make 15K and the next month you lose 2K. Like that's not that's not predictable at all. So looking at asset bubbles, I don't really like that they. And I said this in a prior video. You guys know if you're subscribed. I said that we're going to get a 50 basis point cut. I said that. I literally that's what it's not hard to predict. I don't want to act like a genius here, but it's going to happen. It was pretty obvious, right? So look, let me get into more of the something really important here. It is extremely important. I'm going to start off by recommending you guys have more oil and gas. Why? because commodities will fare better when interest rates are lower. There's going to be volatility in the market, but there's still going to be demand for commodities. All right. So although I'm not a commodities trader, I like oil and gas a lot. With my one-on-one students and investors that I'm going to be starting to focus on, I'm going to be picking individual oil and gas companies. But for YouTube, for my YouTube family here, look, just keep it simple. Just go XLE. XLE. All right. XLE is the oil and gas ETF from Spider. Spider is a great company. They have great ETFs. So look, you need to have 10% of your money in XLE, I would say. XLE is great. They have a great dividend. It's fantastic for retirement. So if you want stable returns, I would say XLE, and I will also go a little bit higher than that, guys, and go for XLE covered calls. All right, so let's go on the XLE covered calls. It's finally a little bit like sweater season here. I'm happy. I love the fall. I haven't seen fall for 5 years because I was traveling to warm countries, but that's besides the point. XLE is very good. All right. And honestly, looking at inflation, it hasn't been properly contained at all. So they're trying to fight inflation right now with these cuts. I don't know if it's going to work, guys. I don't know if it's going to work. They're trying to implement a soft landing, as they say, right? But I don't know if we're going to get a soft landing or not. I'm not going to speculate. All I'm going to say is we can't control the market. Watching a bunch of news won't help us either. It's a non-predictable event. What I would do instead is I would be in safer stocks. I would be more in value stocks right now. I would be a little bit more aggressive with my covered calls, going for that 40 delta on the covered call. And then XLE is one of my strong recommendations here. Not that I'm a financial advisor. I'm not licensed. I'm just a guy who's retired young and experienced. All right, so take this with a grain of salt. The Fed's aggressive monetary policy, including repeated rate cuts and potentially quantitative easing, is driving the dollar down, guys. So I'm worried. I'm actually worried. Because guys, I have millions of dollars, and it's all in dollars. I'm worried about the currency because I have dollars. All right, so I do have a Polish bank account. I spent some time in Warsaw, Poland. I have Moldovan lei. My family is from Moldova, so I'm in Moldova now. I have some Moldovan lei. I have some hryvnia from Ukraine. Okay, I'm trying to get away from just having dollars because, listen, things don't look good for the dollar. They don't look good. I don't like it because when I'm out in Europe, the euro is stronger than the dollar. At one point, it was even. Now, I see the bill, and I like to rent nice cars, so I have several cars. I have several homes around the world that I rent. I don't own. I don't like owning. So I just rented a Porsche 718 Cayman baby blue in Warsaw, and it was 3,000 euros for a month. I got a pretty decent deal. But the thing is, when I looked at my bill on my credit card company, I noticed that's a lot more dollars because dollar is weak. And it's not a good thing, guys. As an American, you might feel, oh, America is going to be strong forever. Listen, guys, America's in some trouble right now. We got some problems. We have high crime, high inflation, both Democrats, Republicans, issues on both sides. So I'm very concerned overall because I've made it financially. I don't need to work. I'm making these videos and I'm helping and doing one-on-one coaching because I feel my life's purpose is about this. But I'm worried having a lot of dollars, and I think this interest rate cut is very troubling. It's very troubling, and I think it can weaken the dollar further. All right, so just looking at euros to dollars, euro strong. The Polish currency is gaining strength on the dollar, so I'm losing on all ends wherever I go. Guys, the craziest thing is the Russian ruble is freaking strong. It's doing okay compared to the US dollar. All right, recently the dollar has been losing strength against the ruble. The Russian ruble, the Russia's in war, guys. Like, that tells you a lot. It honestly tells you a lot. All right, the Russian ruble is doing pretty well. People in war, their currency is doing better than our US dollar currency. So I don't know if we're gonna have a fix to this, guys. Diversification is kind of the answer, and also having international exposure is really wise as well. So, and I also want to say, guys, Be smart, be careful, because the Fed, you know, it's all business. Everything's a business. The doctor's a business, the lawyer's the business, the YouTube's the business. Everyone is business. Everyone wants money. No matter how they say, I'm doing this for charity, blah, blah, blah. I also like money, but I also love helping people. All right, so I'm being honest with you. Looking at the Fed, be careful. Also looking at the CPI data, be careful. They're lying. I think they're lying. They're manipulating the statistics. I have a degree in this. Again, they're substituting things. Listen, let me explain to you what the substitution bias is real quick, okay? I told you about the beef and the chicken. Let me explain. The CPI assumes that consumers will substitute cheaper alternatives when prices rise. They're assuming that. Listen, this is crazy. They're assuming when prices rise, you're going to change your behavior. Do you want to change your behavior? Do you want to live a worse life? If you like steak and prices go up, you want to change your behavior? I don't. I still want to drive a nice car. I still want to go on vacations. If I had a wife, I would treat her very well. I would make sure that she's very happy. If she wants a nice bag, I don't want to substitute a nice bag for a low quality bag. No. But they're assuming this. They're assuming this. So they're assuming that you're going to pick cheaper alternatives when prices rise. For example, I gave you the chicken and the beef. And this, by the way, this substitution right here, the substitution bias, this lowers the reported inflation rate by replacing higher priced items with lower priced substitutes. Can you think of substitutes? I bet you they'll pick two different car brands. And I know this doesn't sound like a big deal, but it's a big deal. Beef and chicken, big deal. Mercedes and Honda, it is a big deal. All right? A lot of this stuff is a big deal. How about Harvard and community college? I don't think they're substituting that yet. I don't think so. But imagine they substituted the cost of education, Harvard versus your local community college. Is there a difference there? Of course. Of course there's a difference there, right? So I don't know about you guys, but the Bureau of Labor Statistics occasionally also, this is also, this is how you trick with statistics. I'm not going to say I have a statistics degree again. I'm not going to mention Goldman Sachs statistics in this video again. All right. The Bureau of Labor Statistics occasionally, if there wasn't enough proof that these guys are BSing you hard, if for you to pay attention and learn trading on your own and not rely on the government and watch a bunch of nonsense videos on either political side, occasionally the Bureau of Labor Statistics changes the weights of different categories in the CPI basket for reflecting shifting consumption patterns. Guess who determines a shifting consumption pattern? They do. So if college goes up a lot and the prices of gas goes down, they're going to say, oh, gas is very important right now. We're going to put 50% weight, as an example, 50% weight on gas. And college is not that expensive. People are working. Watch, they're going to start saying this. Oh, people are educating themselves online nowadays. They're going to take down the weighting in the CPI from education to gas just to manipulate the number. Now, again, this is what they do. I don't know the specifics. I'm not looking at the CPI basket because I don't. Why would I want to look at a bull, a bull-s thing, right? I don't curse, but why would I want to look at some nonsense? I don't pay attention to this type of stuff because it doesn't matter. I'm focused on a more individualistic level of how can I have the highest returns in the market for the level of risk that I'm taking. So how can I get a good, strong return without taking high risk, which is called a Sharpe ratio. Go over that in a different video or one-on-one. Now that I'm a one-on-one coach, I only one-on-one coach. Email down below or first link. I'm only focusing on that right now. I want to go old school.